Hey, good morning, options traders. Welcome, everyone. Well, last week I posted an article about the golden cross that's forming in the Dow Jones. And I also mentioned that there is a counterpart called a death cross. And it's a fairly widely watched technical indicator. Usually makes for some pretty good hyped up headlines, so you're definitely going to be hearing about it. So I want to make sure that everybody understands it, and more importantly, why it's probably not going to be so significant in this instance. Unfortunately, I wasn't able to post a video and talk more about it last week, so let's take care of it this week. But as I was putting this together, I thought, you know what? There are probably some traders in here who don't understand the basics of a moving average, what it means, and more importantly, why is a shorter term moving average faster than a longer term? That's important. So I posted that one yesterday, and if you didn't get a chance to see it, it's entitled, Why Are Shorter Term Moving Averages Faster? So you'll want to watch that one first, and then this one will make a lot more sense. So the golden cross and the death cross, these are formed when crossing patterns occur between two moving averages. So yeah, I know, it leaves it wide open for when are we going to call it a golden or a death. Because somebody might use a 20-day moving average and a 50-day, or a 100-day moving average and a 200. There's all kinds of combinations that we could use. But I would say the one that is most often used as a standard, if there is such a thing for this, is probably the 50-day and the 200-day moving averages. So for our purposes, and again for most of the things you'll read, this is what they're going to use. And what they're going to show you is that if the 50-day moving average crosses the 200-day from below, it's a golden cross. It's a bullish signal. And then the counterpart is that if the 50-day moving average crosses the 200-day from above, it's the death cross. Shows that we're going to head into bearish prices. Market prices are going to start falling. So here's the article. Dow just flashed a widely followed technical buy signal, suggesting more gains in the future. And if you look right down here, 50-day crossing the 200-day. So from a technical standpoint, they are correct. The 50-day moving average is just on the verge of crossing the 200-day. But let's also find out why it's probably not so significant in this instance. So to see that, let's go over to the E-Trade platform. So here's a chart of the diamonds. DIA is the ticker. This is the S&P 500 SPDR Dow Jones Industrial Average ETF. So you can buy this just like shares of stock. It's just an ETF, but it represents the entire Dow. So the red line is the 50, and the blue line is the 200. So what the article is talking about is right here. The 50-day moving average is about to, actually it already has technically just crossed, the 200 here in blue. So this is the golden cross. And usually, if you go back through history, a lot of times people have claimed that this is a super bullish signal and that market prices are about to really go on long-term sustained rallies. And that's why they like to hype this up, because it is a fairly widely watched indicator. But it's not really all that good. Yes, you can use it in conjunction with others, and it can be helpful, but I would definitely avoid using it by itself. So let's go back over here and find, here's the death cross, when the 50-day in red crossed from above and right there. So one of the reasons that this is probably not going to work so well here, this golden cross, is that this was a very rapid decline and a fairly rapid recovery. So if you look down here at March, actually from about late February, we started to see the Dow going off a cliff here from the coronavirus. But look at how quickly it recovered between March and May. This little 2-month window through here, 50% of it had recovered. And so remember that the shorter term moving average is faster. But prior to this, we had been on a very long sustained uptrend. So take a look at what the blue curve is doing through here. It's flat. What does that tell you about the past 200 days? Nothing changed. Yeah, we did go off a cliff here, but it was only for a 2-month window. 200 days, looking back, barely picks this up. All it does, it causes little tiny speed bump in it right there, little tiny decline. But for the most part, it was unfazed. So by the time the red curve picked up these declining prices, because remember the red curve too had been in a very long sustained uptrend. So by the time that it picked up these prices enough to drag that curve down, and we got this death cross right here, look where it occurred. Right here, virtually at the bottom. And as another trader pointed out in our group, that if you had gotten in the short side on the way down, you were late. Not only were you late, you were probably in at the absolutely worst time for a short position. You're right here at the bottom. And so now the moving averages are going to work in reverse on the way up. As the prices started to rise, the red line was dropping and then it started to taper off. It's finally starting to pick up these rising prices. Remember that the moving averages are lagging indicators. So the prices have to rise first before the indicator is going to pick it up. So now the red curve is finally picking up all of these candles back in here in this long uptrend, and it's now meeting the 200-day. But the main reason it's probably not going to be so significant here is, again, it was just such a short-term blip. Your blue curve never got phased. It's basically just coming back to meet where the longer-term trend had already been. So I just like to point this out, especially for the new traders who might say, oh, I just read about this golden cross, let me go dump a bunch of money into it. Probably not going to see the rally that a lot of people are predicting. Now, if it occurs, it's probably going to be for other significant news, such as a stimulus package or a vaccine, things of that nature. But it won't be technically based just because of this golden cross. But let's go back and see an example where it actually did work well and why it was different. Let's look at GE. And if we come back here, let's see, where it really started to go off a cliff, back in here. So GE stock was going through a lot of volatility, but still in an uptrend overall. Red curve, crossed it down here, actually got a little bit of a death cross signal. Still not too bad, but if you had gotten short here or out of your longs, it served you well. But notice the difference. The blue curve was also in a sustained uptrend. And so as I talked about in that previous video, when they cross, assuming that we're going to get this long sustained downturn, it's going to be at a peak. See, notice how this blue curve is rising and the red curve crosses at the peak. So now the red curve is below the blue and prices are coming unraveled. And finally the blue curve starts to catch up and they keep falling and keep falling and keep going for years. That's a little different story from a 2-month window. And so that's the first thing, is that in the Dow, this blue line, the 200, is just flat, which is saying that really nothing happened over the past 200 days. That is not true here. So the reason that this is more significant is that, think about what an average tells you. That when the red line was moving down, the average price is performing worse than it was over the past 200 days. Something has changed. And in GE's case, yes, we had a lot of bad fundamental data that was coming out. But the 50-day moving average is showing that the performance is worse than the previous 200 days. And so it just kept falling. The blue curve is falling. Look at that's another thing too. See how the blue curve finally caught up and is following it? This is a long sustained downtrend for fundamental reasons. And once these curves start running parallel, that's usually another good sign of a defined trend. See how these red and blue lines are running side by side through here? That's a very different story. Now over here, how did the golden cross fare? Not really so hot. Yeah, you might have caught this little bump right here, but more bad news came in. Red curve has now dipped below it. So if you go back to the Dow, hopefully you can see why I don't think it's going to be all that significant here, because the blue curve is just flat. Nothing happened according to the blue curve, the 200-day. It was just the red curve that picked up this little blip. And so now to try to make a big case for saying that the market's bullish, I think it's going to do exactly what it would have done for you here on the short side. It's going to get you in at the absolute wrong time. But regardless of your reasons for getting in or out of the markets, hopefully this helps you to understand a little bit more about moving averages and the golden cross and the death cross. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.